Welcome back, everyone. You're watching our solution series for the UP PGT Economics 2013 paper. If you're ready to tackle the next 10 questions, then let's get started. In the last part, we covered the first 10 questions. Now, in this explainer, we're going to solve questions 11 through 20. These questions really touch on some very important fundamental concepts in economics, so let's dive right in. So the first question of this set, question number 11. In economic theory, what does the term ceteris paribus signify? Your options are A, demand and supply are equal, B, other things are stable, C, a state of full employment exists, or D, cost and revenue are stable. This is a really foundational assumption in economics.
And the correct answer is B, other things are stable. You see, ceteris paribus is a Latin phrase that literally means all else being equal. Whenever economists want to study the effect of one variable on another, like the effect of price on demand, they assume that everything else is held constant. This assumption helps them isolate specific economic relationships.
Moving on to question 12, which is about the Cobb-Douglas production function. The question is, in this function, what would the elasticity of substitution between factors be? Will it be unstable, equal to unity, greater than unity, or less than unity? The answer to this is quite straightforward. B, equal to unity. This is a standard defining property of the Cobb-Douglas production function. Its elasticity of substitution is always equal to 1, or unity. This is one of those properties you just have to remember, as direct questions on it are very common in exam. All right, let's look at question 13. How is the accelerator measured? You're basically being asked for its formula here. The options show different ratios related to changes in income, investment, and consumption. Which one is the correct formula? The correct answer is D, which is the change in investment, delta I, divided by the change in consumption, delta C. The core idea of the accelerator principle is that the demand for investment goods is derived from the demand for consumer goods. As soon as the demand for consumer goods rises, firms have to invest more to meet that demand. This formula captures that direct link. Question 14 asks, in which market would a monopolist want to sell? A place where the elasticity of demand is A, greater than 1, B, equal to 1, C, less than 1, or D, 0. This is a great question about where a monopolist wants to operate on their demand curve. And the correct answer is A, where the elasticity of demand is greater than 1. Now, the logic behind this is really interesting. A monopolist always operates on the elastic portion of the demand curve. Why? Because that's the only place where their marginal revenue, or MR, is positive. If they were to operate in the inelastic portion, reducing the price would actually cause their total revenue to fall, and no profit-maximizing firm would want that. Now we come to a very important macroeconomic concept. Question 15. What is the crowding out effect? The options are A, removing industries, B, reducing investment, C, increasing investment, or D, a reduction in private spending due to an increase in government spending. The correct answer is D. And this slide shows the mechanism beautifully. See, when the government increases its spending, it often has to borrow money from the market. This increases the demand for funds in the capital market, which pushes interest rates up. Now, when interest rates are higher, it becomes more expensive for private companies to take out loans, so they reduce their investment. This entire process is known as the crowding out effect. Question 16 is a classic. Who developed the concept of the liquidity trap? Your options are Keynes, Friedman, Fisher, or Pigou. The right answer here is A, Keynes. John Maynard Keynes introduced this liquidity trap concept. It's a situation where interest rates fall so low that people prefer to just hold cash rather than investing it. In such a scenario, the central bank can't stimulate the economy, even by increasing the money supply. In other words, monetary policy becomes ineffective. Our next question is about Hicks's business cycle theory. What is its foundation? Is it based on the interaction of savings and investment, or on price fluctuations, or is it based on the interaction of the multiplier and the accelerator? The correct answer is D, on the interaction of the multiplier and the accelerator. According to modern economists like Hicks, the economic ups and downs we see, what we call business cycles, are the result of the combined and dynamic effect of the multiplier and the accelerator. This interaction is what drives the entire cycle. Now for a question from the ISLM model. In an ISLM analysis, what is the result of an increase in the money supply? Will the IS curve shift to the right, the IS curve shift to the left,
the LM curve shift to the left, or will the LM curve shift to the right? The right answer is D. And the great thing about this slide is how clearly it shows the effect. When the central bank increases the money supply, the LM curve shifts to the right, from LM1 to LM2. As you can see, this creates a new equilibrium where the interest rate is lower and the national output is higher. It's a perfect illustration of expansionary monetary policy.
Question 19 is related to the Indian economy. Which committee was formed for tax structure reforms? The options are the Narasimham Committee, the Godgil Committee, the Chelia Committee, or the Kelkar Committee. Questions related to committees are frequently asked in these exams.
The correct answer is C, the Chelaya Committee. The Raja Chelaya Committee, formed in 1991, was focused on tax reforms. Now, to avoid a common point of confusion, remember that in the same year, 1991, the Narasimham Committee was also formed, but its focus was on banking sector reforms. This slide clearly shows the difference between the two. And now for the final question of this set. When was NREGA, the National Rural Employment Guarantee Act, implemented across all rural areas of India? You're being asked for a specific date here, so look at the options carefully. The correct answer is A, April 1st, 2008. This timeline shows the rollout very clearly. You see, the scheme began on February 2nd, 2006 in a few selected districts, but it was extended to cover all districts of the entire country on April 1st, 2008. So that's the final, most important date to remember. So let's quickly recap what we've learned from these 10 questions. We revised fundamental assumptions like ceteris paribus, understood the mechanism of the crowding out effect, and saw how monetary policy shifts the LM curve. We also covered important history from the Indian economy, like the role of the Chelya Committee in tax reforms and the implementation date of NREGA. All of these are extremely important concepts for the PGT exam. So we'll end this explainer with a question for you. Of all the concepts we discussed today, like crowding out, the impact of monetary policy, or tax reforms, which one do you think is the most relevant for the Indian economy today? Definitely give that some thought. We'll solve the next set of questions in the next part. Until then, keep learning.